Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are talking about. It's going to be financial topic related, wealth building, uh, finance, or commodities. I'm going to give you my financial opinions as we go, and let's jump right into it. And again, if you want to follow me, it's at finding_finance. And if you want to join the website, if you need a little bit of help navigating these markets, finding-value.com. We do talk about individual companies. We talk about market conditions, ratios, all of the fun stuff. We still have a discount going on. It's going to end here very soon. 8/15 is the last day for the 50% off coupon code August. So, Uranium Insider says URNM compared to spot uranium miners versus the metal closed last week at a 5-month high. Here's on the daily chart. So we got Justin starting a chart. I like it. We've got the nice little kind of bottoming pattern, and it's starting to break out for URNM, breaking out against the metal itself. Looks very promising, and hopefully we get a big move in uranium and the miners. This is URNM versus the metal itself. Zoomed in on that right-hand side, you can see a nice, good bullish engulfing pattern, which generally is good to move higher. And we'll see if we get that move over the next few weeks. We got Mac 10 here. I know he's been a bearer on a lot of these things, and rightfully so. NVIDIA is through the 50-day for the first time in 2023. And the way that I kind of view this, if you were to back out even further than what he's got, I do think that this is a double bottom pattern, or a topping pattern, I should say. It's a double top. I keep saying bottoms from commodities, but double top, and the euphoria, the AI is going to solve everything, blew this to the upside further than this side. So it's distorted, but I do think that this is going to actually come back lower. NVIDIA is the most expensive stock in the stock market, and that's generally not a good place to be when interest rates are moving higher. So I wouldn't be over looking at NVIDIA for a long position anytime soon, as growth stocks, and especially one that's got the most valuation in it. And with interest rates going up, I think this has got an X on its back at some point. But that's me. I wouldn't be in it. Too richly valued. We've got Logan here. It says the hilarious part of the 2012 to 2023 housing bubble crash calls. The data shows it's been best loan profile data in our history. Our history. What that means is that there's not going to be any forced sellers. Men not reading has been the strife of all fanatical cult groups going back centuries. And these are all the people talking about. We got Michael Burry, the Big Short there. What we call this is the big long. The big long is the commodity market going against equities and all the other stuff. So we have the big long going on. Logan, again, it says running 2008 housing inventory channels didn't work because credit channels were different. I know why analysts want to get ahead of the curve, but this is a lack of discipline. And you can see that if you look, you can see the inventory was increasing that entire time. We're doing the exact opposite. Inventory's been declining. You can see the triple, like the head and shoulders top here, that's an end of trend pattern. We've come on back, and we've just been coming down, 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 down. Now, I don't know how much lower we're going to go in inventory. We're basically out of existing inventory. We're at a very low level, I should say. I know some people are going to say, well, the trend line breaks, it's going to go up. Well, what if we break the trend line like we do in the mid-90s here? We go up to average, we go back down. What if it takes this amount of time for us to get all the way back up to this peak? That could be like, what is that, over 10 years? What if we have 10 years of inventory slowly moving up and the affordability being bad, but the buyers are still there? They just can't afford anything. So prices can't really fall too much. And if they fall a little bit, they get bought up by homeowners that continue, or potential future homeowners that continue want to buy stuff. So I don't know. I don't know about that for a lot of those housing crash people. It's been a while. Let's go back to the game plan. The first leg down will likely feel like March 2020 and therefore entice buyers. But I think that there will be another bull trap until the Fed panics. This market won't bottom. This is the double top SPX. Nvidia's just went, because the AI screen went all the way up. But this is a topping pattern. You can see the head and shoulders. Comes on down. Then you get the Batman pattern. And this is either a top here, or maybe we get all the way to the second kind of top there. And then I do think this is going to do something like he's got. I do think so. Here's Bill. Here's the update lumber prices down 29% year over year. I know a lot of these guys talk about lumber prices, but we've got basically a retest. All of the commodity sector has broken out, it's come back, and it's done a retest. Now, is this just a retest where lumber prices go back up? Or is this something that's more permanent? Because they said, well, if lumber prices come back down, we are in some gigantic bear market. And maybe they're right, maybe they're wrong. To me, this chart doesn't look stable. It looks like from 2020 forward that the chart hasn't really stabilized. And it looks like it's trying to do that here recently. So I don't know if I would use this data and say, oh, lumber's describing a gigantic boom, which then went into a gigantic bust. I think the market, because they shut it down in 2020, is throwing signals that may or may not be legit. It's kind of like, what I would expect is you've got a steady production, a stable production of lumber. And if the demand exceeds the lumber supply, this will start to rise, which, if it starts to rise from a stable point, is an actual indicator signaling that demand is outstripping supply. But what if you completely destroy the demand, completely destroy the supply all at the same time, and you get this gigantic move in some of these, commodities? I don't know if those signals are legit for a period of time after that, because the market needs to stabilize, and we don't know how fast these things stabilize. So we've got, interest rates and affordability rocketing higher, and we've got lumber, probably supply side, also coming in higher with prices as high as they were. I think the market needs time to stabilize, and I don't know how long that will take. I think it'll take some years. Peter says, what do you think of this setup forming a nat gas? I absolutely love it. I absolutely love it. Very good formation setting up there. And I think we could be ready to go this winter. I don't know about the fall. The fall might still go sideways or maybe slightly higher. But again, what we're looking at is look for TTF, Dutch gas, Dutch TTF. If that starts to rocket higher, I think it's going to drag natural gas higher around the world with it. We have not really solved the flow problem. Europe hasn't. So yes, they can fill their inventory up, basically cram it full. If they get a really cold winter, that inventory won't be enough with the flow rates that they've got to come out unscathed. I think prices are still going to go up dramatically. So even if they have full inventory, they don't have the flow rates flowing to them like they did in the past with the pipeline from Russia. And that's really what I think the market's getting jittery about. We had the biggest one-year home sales crash ever in 2022, and still in 2023, with 7% rates, we will end the year with nearly 5 million total home sales. What a lot of people on Twitter missed is that they believed existing home sales were headed towards 2 million. He says people aren't afraid to buy, they literally just can't buy. Full stop. Monthly price to buy doubled in the span of 2 years. And then they show the median income ratio, and then they show the bubble. I think they're wrong. And this house payment to median income ratio is also wrong. That data is not correct. Reventure Consulting is the one that created that data. What I think he did is he took the median price of a house, or he took the house payment to the median income ratio. The problem is no one is buying homes that is of median income right now. They're all on the upper end of the median income. So I don't think their house payments are as high a percent of their income as what he's stating. That is why sales have dropped. That's why when you read this, we had the biggest one-year home sales crash ever in 2022. The sales crash came from the unaffordability of this right here. But the crash occurred because it's pricing out the bottom end of the market. So all these median incomes are not buying, it's the upper end that's buying it because we have a housing shortage. So it is, if you have the largest shortage in history, what you're going to see is you're going to have to price out the bottom end of the market. The people who are making median income are going to be priced out of the market. The bottom portion, they're not in it anyway. Those are starter level jobs. So if you're in the median income, you're not buying a house right now. It's unaffordable. So he's saying, well, let's compare it to the people who aren't buying homes. It's 40% of those people, the house payment to median income, it's 40%. Yes, it's unaffordable, but those people aren't buying it. My opinion. My 20-year mortgage interest rate's 2.625%. I'm not paying anything extra on it. If I had one of these new 6-7% rates, I'd pay extra to the principal every month. The math matters here. What is your strategy for paying off your mortgage? And Dave Ramsey did a study. And what he found is that a lot of those people who became millionaires, and what he did is he looked at all the millionaires and said, how did you do it? And what they did is they bought a house at some point and they paid it off as fast as possible. Then they started to invest afterwards. Well, here's the problem. If you ask a bunch of millionaires now how they would approach this, they'd say, well, crap, if I had an interest rate of 2.625 and the inflation rate is 5, 6, 7%, I wouldn't pay the mortgage off. I would go invest the money. And if you looked at all the people that were millionaires, they were generally older individuals. They grew up with higher interest rates. They were paying above 6% on their home. So the best strategy there is to pay that off as quickly as possible. Two different strategies would occur if you had low interest rates like we did over the past 5 years. I'm not paying my mortgage off early. I'm just going to let this inflation rip it apart. If you were to do the math and you were to do a discounted cash flow model with higher interest rates, then your fixed rate mortgage, what you're going to find is the money that you borrowed under those low rates in today's purchasing power is actually, you borrowed more purchasing power in 2020, 2021, 2022 than what you're paying it back in purchasing power with your inflation rate greater than your interest rate. So you don't want to pay it off if you want to do the math. Now, from a psychological standpoint, maybe it's different for you and you want to pay it off early because of the psychological benefits of it. But that's my strategy, is I'm going to increase my cash flow as much as I can through dividends and all that, and let the dividends that pay a much higher rate pay off my mortgage. It says if you can't handle a 10-20% decrease in the price of your investments, then stay on the sidelines and collect the 0.05% in your savings account. I think the saving accounts have gone up a bunch, but the markets do have volatility, and the volatility can be rough for certain people. The way that I overcame that volatility is if you know how to price assets and you know the assets that you're in are undervalued, you know that at some point in the future that they're going to become more expensive. Then I looked at the market conditions for the rotation of that money and for those valuations to change, to occur. So that also helps. And then you can also look at technical analysis, which can help you as well and say, yeah, this is definitely bottoming. It's got a cheap valuation on the ratios, and the market conditions are changing across the board for the money to flow into them. That's about as good as you can get. Then you still have to be patient. You still have to go through these declines because, especially in commodities, they go up and down dramatically. And it's just the way the markets are. The more volatile something is, the higher that stock generally can go in a shorter period of time. So the volatility is also a measurement of how much it can go up in the short term if the market conditions are ripe for it to go up. It says, don't spend money to show people that you have money. Now, I do have a problem with this. What if someone gets a lot of money? What if they've got like $10, $20 million and they're like, this guy says, don't spend money to show people that you have money. Well, you're going to spend money and it's going to be shown at some point, irrespective. If you buy a new car, you bought a new car. If you buy a new house, you bought a new house, and people are going to notice that. Obviously, your intentions might not be to spend money to show that you've got it, but at some point you have to spend it. Otherwise, it's just going to sit in an account making a lot more money. But I understand what he's saying. Don't spend money to show off. That's really what it is. But at some point, you might want to do something that you don't normally do. What if you got $10 million from investing and all the hard work of figuring out how to master the markets, you mastered your emotions, and you say, you know what, screw it, I'm going to go buy a race car or a track car that you want to go to the track with. And obviously, it could be a very expensive one. It could be $100,000, $200,000. But if you got 10 million and you're cash flowing $1 million a year on 10% of it or something, why not? Why not at some point? You only live once. You got to YOLO. Don Johnson says the average used car price is back below $30,000 again as the used market is resuming its implosion. The one thing I don't, how do they calculate this? Because generally speaking, used cars generally go down. They don't go up. So I don't know how they account for it. I mean, collector's cars, you might want to look at collector's cars, but I don't know. I don't know how this is calculated. So I thought it was interesting that it was going down, which is good because if I want to buy a different car or another car in the future, it's always good when it's cheaper. 60% of millennials and Gen Z said they would prefer to spend money on life experiences now than save for retirement, per Bloomberg. That's crazy. Only 5% of small businesses think now is a good time to expand, which is, they say, a signal. I'm in the opposite camp. Every single time these bottom, this is generally the best time to actually invest in the business. So if the herd thinks it's a bad time, generally that's a good time to actually do it. It's generally a good time to invest too. In general, you want to invest before the big trend comes. That's generally when prices are the cheapest. You could say lumber would be the cheapest. The materials are the cheapest. Is when everybody has the worst sentiment. And if you notice, it's at the bottom of every recession, which is when you should be buying stuff. So if they think it's a bad time to expand, that's generally the best time to expand. You just do opposite of everyone else. Here's one. It says the interest rates on the 30-year mortgage are now at their highest in 23 years. New home buyers are now spending a record 40% of their income on the mortgage. So now, since Nick Revenge Consulting released that information, now everyone else is parroting this 40% of their income to mortgage. Meanwhile, the median sales price of a home in the U.S. is at 560% of the median annual income. Problem is, I don't think the median annual income is buying all these homes. The majority of median income people are not buying homes. They are above median income. My take on it. Stock market corrections are a choice, not a requirement. It's up to you as an investor. Besides, it's been much more of a sector rotation story than any kind of correction. Energy versus large cap growth. So these are exact opposites. Good one to compare to. Energy is an inflation-sensitive asset. Inflation goes up, interest rates go up. Large cap growth, the growth makes it very sensitive to interest rates. So this will probably go sideways to lower with large cap growth. Value is where you want to be, and value is energy. So when we see this outperform sector rotation, money rotation, value should outperform growth. And I think that's going to be the case going forward for a good amount of years. Here's Canadian CDNX is starting to look very interesting. Second inflationary wave is incoming. Get ready. So he's got that first fractal or first wave move up, came to the top of its resistance, pulled back, and now we are entering what looks to be wave number 3 is what we call it. This is wave 1. Wave 2 is the pullback, and then wave 3. And a lot of people who know Elliott Wave, I think, are starting to jump on the wave 3 bandwagon. Wave 3 is the biggest wave. We're going to see a big move to the upside most likely, and hopefully that occurs here and is underway. Uranium's in that same spot. Here's uranium versus TAN, which is the solar ETF, a 3x outperformance for nuclear when if we confirm that neckline. And the neckline is basically right where we're at. So this is a ratio chart with a shoulder, head, shoulder, and a neckline right where we're at. I'm seeing these inverted or inverse head and shoulder patterns all over the place. They're everywhere in commodities. That is a good thing. We can also see topping pattern in bonds. Bonds are topping. I also think that we're seeing signs of topping patterns in the Nasdaq companies. So it's going to get very interesting here when the money rotates over. And if we are at the beginning of wave 3, which this is indicating wave 1, wave 2 pullback, wave 3. That wave 3 is the big one, and we're kind of in it right now. Just started it. Called the bear market low back in 2020, and the uranium miners did 370% in its baby bull move. The big bull move's coming, guys. But the sector's just getting started. It has not even broken out above its base here yet. This is a 15-year base. Bigger base, higher in space. So it's all kind of aligning in all these sectors. It's a confluence of information in commodities, yields. All of this is all telling us a picture. It's painting a picture. And that picture is higher commodities. U.S. home builders successfully navigated the mortgage rate shock while simultaneously working to normalize backlogs that had accumulated during the pandemic housing boom and supply chain crunch. Homes in backlog at 9 of the nation's largest builders. So the home builder backlog is shrinking a little bit. And these are all the builders there. And these all look pretty good, the home builder stocks do. And I do think that the backlog will continue to go down if mortgage rates or interest rates stay high. Fed better pivot for the economy gets a gunshot to the face. We do have an M2 that's coming down. The one thing that a lot of these guys are not putting in there, it's really M2 money supply times your velocity. The velocity's kicked way up. So we're actually still increasing if you multiply the M2 money supply times the velocity. So it is still inflationary at this time. It's not just the U.S. Bond yields right across Europe are breaking out again. Greece looks to be targeting a move of to 8%. Inflationary pressures are also building. If you notice, guys, if you look at this, it's that inverted shoulder, head, shoulder that we're seeing in all of the commodity stocks. Yields and commodities they're correlated. And they're correlated because interest rates rotates money back into commodities. So if yields are going to go up, what do you think that's going to do to the Nasdaq prices? It's going to be a big headwind for Nasdaq prices. And that money's going to sell out of it, and it's going to go chase the commodity companies, and we're going to get FOMO eventually. Fear of missing out. I like how Logan just keeps ripping on these guys. Why have home prices surged in 2020? Because the supply of homes for sale, aka inventory, has plummeted. However, don't expect this trend to continue in 2021. This guy's a broken clock, and I don't understand why he's jumping on this the way he does when inventory is low. Just wait for the inventory to come back. Guys need to calm down. Long-term investors don't panic sell, we panic buy. I've said that before. And I don't think he follows this channel, probably not. But that's where I'm going to end it, guys. That's what we've got for today. Thumb up for the content. Subscribe to the channel if you haven't already. And yeah, that's all I've got. That's kind of covers it all. Everything looks good. So subscribe to the channel, guys. Subscribe to the website if you like. We'll catch you later. This is Finding Value.